I think there's an element of risk reward that comes with any type of investing, and industrial can be great. I'm a big advocate of it, but I also think the average investor should probably steer away from it, or find someone to JV with, find someone to partner with, join as an LP, or invest in a fund that already does it. Otherwise, there's a lot of risk that comes with it, and that could be a huge risk. If that tenant doesn't renew, that's a problem. That's a big problem for me. What I'd say that there's an advantage with industrial and how you can mitigate that is that all have a 6-month window where they have an option to renew. So either they exercise that option to renew 6 months before the lease ends, or they don't. And at that point, I have a 6-month window where I can start looking to find a tenant.
Ladies and gentlemen, my name is Jesse Fragale, and you're listening to Working Capital, the real estate podcast. My special guest today is Chad Griffiths. Chad has been in the industrial real estate industry since 2005. As a member of the Global Commercial Real Estate Company and a partner with his local firm, Chad has completed over 1,000 deals with clients ranging from small companies to large institutional owners. As an active investor since 2014, Chad is co-owner of 150,000 square feet plus of industrial properties. Chad and I also speak with Tyler Cobble once a month or once every 2 weeks on his podcast. You can check that out, Tyler Cobble on YouTube. Chad, how you doing today?
Yeah, I'm doing really well. Thanks for having me on. And yeah, I love doing that call with Tyler, just getting to talk with you and Adam and Tyler once every 2 weeks and get a pulse on what's happening in different markets. I think that's such a fascinating call. I look forward to it every time.
Yeah, me too. You know, you and I, we are obviously both in this industry, so we talk about real estate a lot. Sometimes you can, you're hearing the same thing over and over again. But for those that don't know, it's the call's pretty cool because Tyler, he will play host, and then you have Chad, yourself in industrial. I'll usually speak a little bit more to office and some multi-res stuff. And then we've got retail expertise with Adam there as well. So it's really cool to get the perspective from the different asset classes, because there's always something a little bit different as it relates to deals that we're doing and just the way they're done.
Yeah, it's fun. And you're right. All I kind of look for is there like one thing that I can learn from this? And with us spread out over different asset classes and all over North America, really, you're bound to pick something up. So yeah, I look forward to it every time.
Yeah, for sure. And it's a live stream. So I'm probably, for listeners, I would just type in Tyler Cobble. I think it's like he posts it on Instagram as well as I know for his YouTube channel. But if for those that don't know, Tyler Cobble, Cauble, we'll put it in the show notes and hopefully you can grab a link there. So Chad, thanks for coming on. Like I do with all of the guests here, if you haven't been on the podcast before, I'd like to go into a little bit of a background on the guest and basically how you got into our industry. It sounded like you're very similar to me, or kind of a little bit of the inverse of me. I think you got into brokerage before investing, but maybe give us a little bit of background. How did that come to be?
Yeah, it actually goes all the way back to 2022, 2023. I was buying and selling houses, flipping them with a couple friends. And we didn't do great, but we didn't do too bad. But I really got the real estate itch. So I decided to get licensed in 2004. So I originally joined a residential office to sell residential real estate. And I did it for a year and just didn't see a long-term career in it. There's people that do really well in it and love it and they thrive in it. But there's so much emotion involved in it. And then you're working every weekend, you're working every holiday. And I just didn't see that for the foreseeable future. So started asking around people who I knew worked in commercial real estate. And I thought it'd be office towers and shopping malls, kind of the glamorous area of commercial real estate. And just so happened the office that I ended up joining was heavily focused in industrial. So that was 2005 that I joined. Knew very little about industrial at the time, but pure accident. And it was Bob Ross. It was a happy accident because it's fast forward 20 years. I'm still same office, become a partner at the firm, started investing in 2014. And one of the coolest things that I like to say about my journey is that I now own the building that our office is in, which is a multi-tenant flex building. So I own the building now. Of when I started at a brokerage that I had no idea what industrial was, to fast forward to today, it's It's pretty much all I live, breathe, and sleep it all the time.
Yeah, that's great. It's funny. We talk a lot about the investment world of real estate and working in real estate, and those things sound very similar, but they're pretty different. I think what it takes to be an investor in real estate, or in general, if you make that part of your job or your side hustle, I think there's a bit of a different DNA when it comes to investors and entrepreneurs that not everybody, even people in our industry, want or care to undertake.
Hmm. Yeah, I
So
agree. It takes a different type of person for sure to be an entrepreneur or to be in brokerage.
So you went for the not so glamorous side, as you put it. I don't know how glamorous office is these days, but in industrial, when you first got into that world, what was there anything that surprised you, or was there anything that kind of stuck out that you really liked, or really did not like in that space?
Yeah, I gravitated to it pretty quickly, just for one main reason being how broad it actually is. And I didn't know it at the time. My thoughts of, if I would have thought of industrial real estate, I probably would have thought of like a big factory or maybe like a big distribution center might have came across my mind. But after and when I started, I just went through as many buildings as I could. That's how I wanted to orient myself and really get an understanding of what it is. And I'd walk through one tour, I'd walk through a 2,000 square foot little industrial bay. And then the next one, I'd be walking through a 300,000 square foot distribution center. And there's everything in between on that. And I just found it so fascinating. All these businesses that if you're not working in the industry, you wouldn't even think to look at these, let alone appreciate how important they are for our economy and just life as we know it. And you start going through and you just start seeing a local entrepreneur who's making something out of a small little factory, and then it gets shipped off to a warehouse, and then that might get shipped across the country, and then it might end up in another continent. That to me, I was just so fascinated with how everything was interconnected and global. So that small 2,000 square foot manufacturing space was making stuff that could literally end up across the world. I just found that so fascinating from that standpoint of that maker, builder, entrepreneur mentality. I was enthralled with it from day one.
Yeah, it's amazing that when we come across, like, we focus on office, we'll do some retail and some industrial, and I always find it amazing when you come across industrial, that in contrast to, say, office or retail, if an office or retail tenant has 500 employees, everybody knows who their name, right? It's not a surprise. But you'll look at some of these industrial deals, you see 400 employees, 200 employees, and you have no idea what the company is, and then you find out, like you said, they make this product that goes around the world, and they could be a huge company, but it's not, it's kind of these unknown companies that hold up our economy.
It's so true. And I still come across businesses that I never would have thought about. One that I just went through, this was a couple months ago. It was a smaller space. It was only about 5 or 6,000 square feet, but all that this company did was repair arcade games. So the shop was full, probably 100 pinball machines and old Pac-Man games in various states of repair or tear down. And I just remember I walked in there. I'm like, who else would even think about this? But of course, those things break down and someone needs to fix them. This company just happened to do that. And that was their sole business, was just repairing arcade games. So even 20 years later, I still come across businesses that just never would have even thought about.
So we've seen a lot of change over the last few years with different asset classes at different stages of their cycle. I think, at least in my career, this has been the last few years have been the biggest shifts for different asset classes: retail, office, multi-res, industrial. When I first started, industrial was not sexy at all. It was kind of just seen as, like you said, not the flashy side of things. Now we're seeing record prices in Toronto and other major markets in the States, record low vacancies. What kind of trends are you seeing on the industrial side, and how has that evolved over the last few years?
Yeah, I'd echo your comments completely. The 20 years ago, it was out of public purview, but literally and figuratively,
Yeah.
because literally it was, most industrial was tucked away in industrial parks out of the public purview, where they were designed to be not seen. Now, fast forward, and everybody sees a distribution center and warehouses and everything on major roads close to airports. It's all of a sudden come into the public view. And that's also attracted a lot of institutional money, just a lot more investor appetite in general. And a lot of that was also fueled from e-commerce growing and slowly eroding market share away from brick and mortar retailers, and that got accelerated from 2020 to 2022, call it. That trailed off. I think that there's a healthy return back to people wanting to have that experience of being in a retail store, and I don't think retail is ever going to die, but those dynamics have shifted, and that's benefited industrial. But it also came with a negative, a two-sided coin. The positive is it brought a lot of attention, a lot of desire for it, but it also brought a lot of development. And we saw this. It's starting to trail off right now. Development can be a long game. It can be a 3-year cycle pretty easily by the time plans and everything gets implemented and then it gets built. So I think we saw a massive ramp up of new development starting late 2020, and that's starting to trail off now as interest rates have just put a dampen on new developers adding new property. But there's a lot of inventory being added, and Toronto is a different market. You're somewhat land constrained. I think in Toronto is probably one of the best industrial markets actually in North America. But if you take other markets, and Dallas is one that I can point to as I've looked into it pretty extensively, they added 70 million square feet worth of industrial space last year. And 70 million square feet, that's a medium size, like that's a city of 500,000-600,000 people. That's their entire inventory of industrial space. And they added that alone last year. So there's markets where there aren't land constraints, where you can build in every single direction, where developers have added so much new inventory that it's put a lot of upward pressure on vacancy rates. It's put a dampen on prices as well, and that's going to take a while to get absorbed. Whatever happens with now that we've kind of at a supply cliff where nobody's really adding new inventory, we might see the opposite problem in a year or two from now. But I think the absorption challenge, getting through this massive glut of warehousing space, is going to be a challenge in a lot of markets. But I also would say that this is the first time I've noticed this in my career as well, is that industrial can clearly be split into subcategories now. All that new inventory that's been added is big box, warehouse, distribution space, call it 200,000 square feet and up. Whereas all the other industrial, and that can be manufacturing properties or flex space or class B industrial, that hasn't expanded at the same pace. If anything, those subcategories of industrial have been relatively flat in every major market that I know of. There hasn't been much added. And even the inventory that has been added, it's at such a premium to the existing stock that a premium on the rental rate also needs to be accounted for. So I'm very bullish still on that Class B manufacturing flex space, and I'd be very cautious on the warehousing space, at least for a next year or so, to determine how quickly does that get absorbed. Is there downward pressure on pricing to get it leased up? And what does that look like as we go through this next stage of the market? But very bullish on the other side.
So you mentioned something kind of interesting there in terms of the classes. Like when it comes to offices, it's pretty, for those at least in our industry, location obviously is a component of that. But, C, B, and A, you're going to have, suburban, older office. B, you might be a more amenitized. A, AAA, you have these trophy towers. When it comes to industrial, you mentioned it a little bit there with warehousing, but how would you categorize C, B, and A as you go up the quality ladder there?
Yeah, and this is something I'm very keenly aware of, how there's different terminology in different markets. I wouldn't have even said Class B industrial as little as 5 years ago. That wouldn't have been a term that I referred to it at all, but it's very common in some groups, especially investors in that Class B space. So I would say, like, if there was a Class A, that's probably going to be a brand new modern building, similar to the office space. It's going to have 40-foot ceilings, large marshalling areas to get trucks in, probably an aesthetic design as opposed to just a bland concrete box. It probably has some extensive architectural features, and everything's going to be modernized. It'll have sprinklers inside. It'll have a lot of power. It'll have very nice office amenities. That's what I would say is a Class A. Class B, I generally, and I don't even know if many people would say that there is a Class C. I haven't heard ruminations of that anyways. It's usually just Class B is how it gets referred to as now. And that's typically going to be older industrial stock. So in Toronto, as an example, I know all the major distribution space that you guys are adding is kind of on the outside of Toronto, spilling into some of the neighboring communities. Very rare to see a brand new distribution center like in just 10 minutes outside of downtown Toronto, but you will see older industrial stock there just because it's been there forever. So that's typically what I'd say. For me to loosely define Class B, call it like a 1980s vintage industrial building. You're probably going to have 20 to 24 foot ceilings, probably don't have all dock loading. It's probably almost all grade loading, and older, dated. You might see some cosmetic improvements, but it's an older industrial building. That's what most people are going to say is Class B. And then that also geographically define it as being within city limits. And I know that there's going to be some distribution space in city limits as well, but call it even more inner city. It's going to be closer to that core than the modern distribution center that's half an hour outside of the core.
So when it comes to the investing side of the business, industrial space, I assume a lot of these are going to be triple net leases. And for those, for those who haven't heard on the podcast before, it's effectively you're going to pay a base rent, and then there's going to be additional rent, which is usually broadly characterized as taxes, maintenance, and insurance that you will estimate every year. Pay the landlord an estimate, and it'll be reconciled. The benefit of that is you basically, from a landlord's perspective, you get the net rent, and there's all of those items are passed through. Correct me if I'm wrong. That's how the majority of the deals that you do would be triple net.
Yeah, I'd say 99%. And even most of the remaining 1%, it would be some uh, tweak on that. So you might
Yeah.
see it quoted as like a gross lease, but then
Then you
property
get into
taxes
the
are on a
lease. Yeah.
base year and they get adjusted. It's very, very rare, unless it's a short-term lease. If someone's doing a 1-year lease, it's just an interim or short-term space, then maybe you see a gross lease. But yeah, 99.9%, they're going to flow through any increase in expenses to the tenant.
So when you're looking from say investors listening that are looking to purchase industrial, there is this that the triple net is one appeal. When I talk to people that invest in multi-res or say they've just bought a couple rental properties, the idea of having one or two tenants in a building, poses a bit of that risk where you now have to be in the business of understanding to a certain extent, underwrite the covenant of the tenant and the credit worthiness of your tenants. So when you first you mentioned that you own the building that you initially started to work in. When you go to these industrial deals, what are some of the big features that you're looking at in terms of underwriting and kind of projecting the risk of the deal, say comparing one to another?
Yeah, that's a great question. And in that one particular building, I own it with 3 other partners that are also partners of mine in other projects. So I've only done JVs. I haven't raised money as a syndicator. It's just my capital and partners' capital that's in there. And my partners and I have pretty much every type of industrial except for warehousing. And I'm not attracted to that warehousing side just from the standpoint that you're competing with the biggest players in the space. So like big sophisticated institutional owners that have resources far in excess of what I could ever have. Whereas that manufacturing Class B flex space, we can compete in that. So that building there, that's a flex building. There's an office tenant in there. That's our brokerage. A hot tub store, a flower store, a cabinet store, an equestrian store. So it's almost like a quasi mix of retail office, even though it's an industrial building. So I like that one. But I also have a property that's a single tenant manufacturing property that's on a long-term lease. We only have about a year and a half on that. So that starts to crystallize that point that you mentioned, is that property is one tenant to manage. And I think that is one of the appeals of industrial, is that I haven't been to that property in probably 2 years now. It's a Fortune 1000 company that's the tenant. They take care of everything. If there's an issue that comes up, they deal with it. If we have to, we figure out how to split cost. But it's very, very easy to manage that property. And that's about a $3 million property. if you were to compare that to a multifamily property, let's just say that's 10 units, maybe more or less, but let's just say 10 units, managing 10 residential tenants and all the things that come up with turnover and issues and just the day-to-day management of a building like that. It's so much more management intensive to manage that one versus the one that I have. Conversely, when that lease comes up, that becomes a potential problem. If they leave, I've got 100% of my income goes out the door with them. So I think there's an element of risk reward that comes with any type of investing, and industrial can be great. I'm a big advocate of it. But I also think the average investor should probably steer away from it, or find someone to JV with, find someone to partner with, join as an LP, or invest in a fund that already does it. Otherwise, there's a lot of risk that comes with it, and that could be a huge risk. If that tenant doesn't renew, that's a problem. That's a big problem for me. What I'd say that there's an advantage with industrial and how you can mitigate that is that all have a 6-month window where they have an option to renew. So either they exercise that option to renew 6 months before the lease ends, or they don't. And at that point, I have a 6-month window where I can start looking to find a tenant. And 6 months in the market, which I know very well and will have all the resources at my disposal, I should be able to backfill that if it came up. But not everyone has that luxury, and not everyone's going to be prepared for that. And I see this happen all the time where properties just go vacant. And I ask the owner, how come it went vacant? They're like, you just weren't even paying attention to it. And next thing you know, the tenant was moving out and we had 1 month to find another tenant. So it happens regularly. So even though the management side of it is easier in terms of day-to-day activities, you still have to treat it as asset management as opposed to property management. And that's be one thing that I really try to do is, you're wearing that hat as an asset manager. How do you maximize the value of that asset? And that goes beyond just managing day-to-day things that come up, and really thinking about how do you maximize the value of that property. So I long answer short, there's definitely risks with it, but I think that those risks are mitigated if you're finely in tune with the market and then that building as an individual asset.
Yeah, I think it's 100% agree. I think a lot of it is planning in a very commercial oriented way. And like you said, sometimes those windows, when we do extensions or renewals, like at least in our market, we're 9 months, 12 months, sometimes that they have to give us notice that if they're going to renew or not, so that we can be prepared to either get it onto the market. And it's not uncommon for us to have space, depending on the size, on the market a year in advance. So yeah, I think it really comes down to if you can mitigate the risks. And I think the other piece, I'm not sure, I'd be curious to hear what type of inducements or allowances are done in your market, but a lot of times that you have to shell out a lot of cash when it comes to the renewal period. If there's somebody coming into the building and they need a tenant allowance of $80 a foot, $50 a foot, whatever it is, you got to be prepared to be able to offer that. Like you said, the big institutional guys are hard to compete with if they're throwing large tenant allowances on renewals. And you got to be prepared for that if you're going to go to the commercial route where that is something that's done in your market. So not sure, are you on the industrial side where you work, are you allowances, free rent, what type of inducements are you seeing these days?
It's a mix, and it's dependent on condition of the space, how useful it is for the next tenant. If it's a space that was customized for the last tenant, then it might require an extensive TI. But even in industrial, it's still relatively minor compared to what an office tenant might want. If they're going in and taking it down to a vanilla shell and then rebuilding it back up, that's pretty expensive to do. So they're going to want to offset that cost to some extent, maybe fully, maybe partially. In industrial, the office itself might only account for 20% of the entire space. And it's not as common in industrial where you start retrofitting an office space. A lot of industrial guys go in and say, yeah, I can make this work.
Good enough.
They're not making their money in the office, right? They're making it in the shop. So more time, I shouldn't say more times than not, because every scenario is different, but quite often it's carpet and paint and some basic cosmetic stuff in the office area. And then case by case on what happens in the warehouse space, they might want upgrades to LED lighting. If it's an older space, they might want some changes, in a new HVAC unit or an extra door added. It's all sorts of things happen, but
Mm.
TIs definitely do come into play. Like $5 to $10 a square foot seems to be pretty common. Sometimes it's zero. And then free rent is also common. It's someone might ask for one to 3 months of free rent on a 5-year term. And depending on the landlord's position, how quickly they feel they can do it, they'll either concede and give a couple months, or they'll just say, we have so much demand for this. It's kind of take it or leave it, unfortunately.
Yeah, that makes sense. So shift gears to the financing of these deals. Do you find that there is a difference with the different commercial asset classes, like putting pure residential aside? I know the US and the Canadian governments, they like multifamily because regular people, normal people live there. When it comes to financing pure commercial deals, whether office, industrial, what does that look like? And when you were buying these first few properties, were there challenges with getting commercial financing, or what did the structure of those deals look like?
Yeah, the first property I ever bought, I just had one partner at the time. Him and I were 50-50, and we actually had the seller carry financing for us. So we set it up as a 3-year term, open term, and then we ended up buying it out about a year later because we bought another property, and then we got conventional financing on them both. So yes, it is a challenge. And I think the one thing that a lot of people underestimate is your upfront costs as well, and then even the structure of financing. It's not uncommon to spend 5 to 10 grand on due diligence, but if there's no reports available and you have to do an environmental and appraisal and a building condition assessment and have a lawyer involved in reviewing leases and all the due diligence that you do, 5 to 10 grand can go pretty quickly. You might be able to, maybe all those reports are available and you can save costs, but like I'd estimate that any investor should be prepared to spend 5 or 10 grand, and if you don't spend it, then that's a bonus for you. But the other thing on the financing side, you're typically going to need 30-35% down, and you're getting shorter amortizations. Like you might be looking at a 20-year amortization on these. So that's where multifamily can look really appealing in my mind. If you can get, because I believe they're doing 50-year
They're doing
amortizations. And
50. Yeah, depending on, I don't know if you have MLI select programs out there, but depending on if you are energy efficient or if you are accessible, CMHC, which is our Fannie Mae Freddie Mac, are doing 50-year AM.
then what down payment do you need on that?
So that's another thing too. Well, here's kind of the catch 22. You can, I think, get as low as a 10% down payment, but the big but is it will be CMHC's appraisal. So that might not necessarily be exactly what the market is, but I would say generally speaking, 20-25% down is is not hard to find. But with everything now, the underwriting is getting a little bit more and more strict, just given where interest rates are at and what the risk is for the asset class in general.
Yeah, and speaking of that, I haven't bought anything in 2 years now. I haven't, and I've been trying to
Mm.
look, but it's the sellers still seem to have that rear view mirror pricing in mind, that early 2022 pricing, and the market has changed. It's the interest rates have completely changed the math on how to make a deal work, if for no other reason than just looking at it through the debt service coverage ratio,
Hmm.
with and call it like a 1.2 DSCR. With interest rates having increased, that increases the cap rate needed to actually make your DSCR requirements. So changing nothing else, it's like I think the market is probably down 15 to 20% across the board from peak early 2022 pricing. And some people are still bullish and they're saying, well, interest rates will come down eventually, and we'll try to raise top line revenue through NAI growth or however they're going to do it. So they're still going forward, and you see that there's still transactions that are happening, but transaction volume by and large on the investment side is down considerably. I was looking at stats earlier. It's the industrial sales in our market was down 50% year over year and down 30% in the actual amount of deals. And then if you start backing out the owner operator purchases and just start looking at it from an investment standpoint, there's not a lot of movement right now. So it takes either a seller that's in a position where they have to sell, maybe they have a sunset clause, maybe they're having a capital calls or whatever it is. It almost takes a forced sale right now for a seller to say, okay, we recognize that the market's down 15 to 20%, and we're going to treat it like a stock. Whatever the market price is what we're going to sell it at. But very few sellers think that way. And if they're in a position where our market's about 4% vacancy. So if you're 96% occupied on average and you're paying your bills and you're saying, well, why would I sell into a down market when I have almost full occupancy? Why don't I wait to see what this market does in the foreseeable future and then reevaluate? So like sales volumes is down a lot, and I think it's just reflective of that bid ask spread, right? It's
Yeah.
that's always there, and it's probably just the worst I've ever seen it.
Yeah, it's so funny because it's like we've used the term when we talk every few weeks that we're in still a price discovery phase, right? Where
Mhm.
people really don't know what the value is of certain things because there hasn't been enough trading. But what I find really funny is that your market at 4%, you contrast that with certain areas in Toronto that are like 24% available, right? Like with the on the office side. And seeing the different dynamics in industrial versus office right now, where they weren't exactly flipped, but 10 years ago it was much different down here. The office asset class, we had certain pockets that were 2%, the 2% vacancy rate. So to see what's happening right now, and even in multifamily, which is for most major markets, multifamily has done very well over the last few years. But now you're starting to see last year and this year, you're starting to see, like you said, these sellers that are still looking at pricing of 2, 3, 4 years ago and are holding on to that idea of pricing. And if they're coming up to now having to refinance at 6, 7, 8% plus, where they had debt much cheaper, that's really going to be the question of, are we going to start seeing those sales? And like you said, be a forced sale that eventually tells the rest of the market this is where pricing really is.
Yeah, if there has to, something has to give in my mind. I can't. I appreciate how resilient people are and how tenacious real estate entrepreneurs are and how they always hold out hope that things are going to get better. Like you could be the
You have
worst
to.
real
You
estate
have to
investor.
be.
You
Yeah.
have to, but you always think tomorrow is going to be better. You
Yeah.
just
Yeah.
every one of your tenants can be saying that they're leaving and tomorrow is just going to be better somehow.
Yeah.
So it's been interesting to see how resilient everyone is, but something has to give, and it just reinforces to me that everything is a cycle, and industrial will go through it too. Industrial is not immune to it. It's been on a high upward cycle right now, but it'll cycle back as well. And multifamily is a perfect example. It's a lot of these markets where I feel for people are the people that bought at the top of the market, so they paid that high 20 or early 2022 pricing, and then they forecasted in 3 to 5% rental growth, and they just assumed that they'd be smooth sailing. Well, fast forward, they've had downward pressure on their rental rates in a lot of markets, and
Yeah.
then they've had tremendous increase in their expenses. So and then they're getting is if guys that have had floating their debt, then they're getting a triple whammy:
You're getting killed.
flat
Yeah.
rents, increasing expenses, increasing debt costs. Like I've talked to a few guys now that are really concerned. So I don't know if the economy regulates itself and interest rates just come in line and give these guys some relief, or if interest rates have to stay where they are for the foreseeable future and these guys just run out of options. But I mean, it shouldn't be lost on anybody that we're in a cycle, just like you were saying with office. Like it's just real estate is going to continuously cycle.
Yeah, and it's for me, and I don't mean this in a disparaging way, but I've never really considered developers investors. I put them more in the speculation camp, and I don't mean that in a negative way, but I just think there are certain factors that they look at that they have to forecast that you don't know which way it's going to go. So, for instance, when you have construction loans over the last few years, if you forecasted at the beginning, all of a sudden you're going from 3% to 9% in terms of your loan, and it's floating most of the time. So you're really nobody could have seen that coming. Or very few people, saw what has happened over the last 4 or 5 years, and had been able to guess on that. So 100%, you can control only so many things, but I think in our industry, a little bit different in the pure investing from my point of view, in that you try to button up those type of risk factors as much as you can. But again, it's like everything. The more you try to lower your risk, the more you're going to lower the expected payoff in the end. So there's that balance there.
Yeah, it totally is. And that's kind of one of the reasons that I have also been very cautious to buy anything, is that I've been trying to stockpile cash reserves just in case I have to do a cash and refinance to meet coverage ratios, or a tenant goes vacant and I can't lease it as quick. But you said best. There's an opportunity cost to that. If just sitting on cash right now versus trying to deploy it and make a return on it, there's always a trade off. And I mean, maybe that's what makes real estate exciting, or maybe that's what gives us anxiety. But I
Yeah.
don't think you can escape either of those if you're in this business.
Well, it's funny too. My sister will ask me like every 4 years, about, or 5 years, about, should I get a fix? Should I get a variable? And like, I'll give her the academic answer, but then I'll say, listen, like, are you going to feel better sleeping at night with a fix? Yeah, I will. I'm like, okay, so the juice for you probably isn't worth the squeeze. Like, you might want peace of mind, and that opportunity cost. Like, if you feel more comfortable with that cash reserve in the bank, and if it's a strategic benefit that you can pounce on something if it comes available, by all means do that. But don't think that there isn't an opportunity cost to that. And that's constantly what we're trying to do. We're trying to weigh these negatives and positives.
Yeah, especially when you factor in inflation, which I'm just very cynical that the inflation numbers we're being fed are actually accurate. So
Yeah.
uh, I still think they've just added too much money for, in a vacuum. If they added 20% of the money, then there's 20% inflation. That's very simple, abstract math for me. So that's going to be the real inflation number that we have to hit. So if you're thinking that that's spread over 5 years, well, that's called 4% a year is probably what we're going to have to account for. Again, in a vacuum, it's a lot of assumptions, but if you're just leaving your money parked somewhere over the next 4 years, there's a chance that it could get eroded by 20%. So not only did you not make a return on that money, but you just lost 20% of its value. So there's a
100%.
real opportunity cost to leaving money in the bank.
Yeah, 100%. And that's why I really like, just kind of a tangent, but if you're in a market where the banks will do short-term GICs, where it's your deposits are protected, and they're callable GICs usually, where say 90-day, 100-day, where you can access that capital at any time. But today they'll do like a 4.5 or a 4, and that, like, to me, at least you're preserving capital. So if
Mhm.
you're gonna sideline it, at least try to ameliorate the degradation of the capital, like you're talking about here, of it just sitting there and losing value.
Well said.
There you go. Okay, Chad. So I want to be cautious of your time here, or mindful of your time here. For those that would like to kind of connect with you, get a hold of you, where can I send them? We'll put some notes in the or put some links in the show notes.
Probably LinkedIn is good, and I'm active on YouTube as well, much like yourself. I think that's how you, Adam, Tyler, and myself all came together, was actually based on YouTube. So yeah, I've got a channel on industrial real estate. So either LinkedIn or YouTube would be great.
Awesome. Yeah. And if you'd like to see any YouTube videos on any topic in real estate, I'm sure Chad and I could probably whip something up, or do some sort of collaboration. So, Chad, we'll leave on this note. Where you see right now the opportunities over the next, say, short to midterm, the next couple of years? Where do you think the opportunities are going to be, whether that's in real estate investing, or kind of the real estate space in general?
I don't really have a good answer to that. And I know it sounds like a cop out. I just think there's so much to account for that I really have no idea what's safe or what's a great investment in the next few years. I'll tell you what my long term
Sure.
outlook is, though, because that's kind of my investment thesis, is try to buy property in an area that has population growth, and so ideally even better if there's some geographical constraints preventing it from growing in every direction. But if you can buy property at a cost basis that's below replacement value, and you can cash flow on it, and you can reasonably protect your downside risk, and you can hold that for 20 years, that's in a nutshell what my strategy is. And I've just done that over a number of properties. But I would say to somebody that if you're looking to buy a fairly priced property right now, and we'll just use industrial because that's what I'm familiar with, and you could buy a Class B industrial building in a good area, and Toronto would be a good example of this, but any city really, where it's, call it $150 a square foot to buy. And I don't know Toronto's market well enough. That might be way out to lunch. It could be triple that for all I know. But if you just arbitrary numbers, if you could buy a property like that for $150 and it would cost $250 to replicate that, and those are like actual numbers, because it's just so much more expensive to build these now than it was back in the day, and then there's reflected in the sale price. If you can buy a property like that, hold it for 20 years, cash flow, pay off your mortgage, and be left with a property that's appreciated, all while cash flowing and paying off your mortgage in 20 years, I think you'll look like a genius. And if you do that a few times, all of a sudden you've got a very nice nest egg 20 years from now. That's long-term approach, and I'm patient enough to do that. And I don't know if everybody is. I mean, looking at crypto, everyone wants to like make real quick money, right? And I think that there could be a play with crypto that I'm not aware of, but I'm a long-term investor, so I really don't. And again, that sounds like a terrible answer. I don't know what's going to happen in the next few years, but I'm reasonably certain that over 20 years, the market will be better than it is today, and I'll have paid off assets.
My guest today has been Chad, the long-term investor Griffiths. Chad, thanks for being part of Working Capital.
Thanks for having me on, Jesse. Appreciate it.